Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. My name is Stock Darts, and as usual, we're going to go ahead and cover the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the U.S. dollar. We'll look at how it's affecting gold, silver, and oil, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat box, and we'll go ahead and take a look at it as soon as we finish covering the markets. If you like what you see here, you like my analysis, you can go ahead and follow me on Twitter at StockDarts. You can follow me on YouTube, StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, such as the one we had yesterday on Netflix's earnings, which is working out very well for me and anyone else that followed me on that trade. Other than that, let's go ahead and get started. Ray, good to see you in here. Hope you're having a good week. First thing we're going to do is take a look at the S&P 500. We're going to look at the ETF SPY. And as you can see, the market keeps running up, and it keeps drifting higher and higher. I think we are finally seeing signs of an impending reversal. Not a top, just a reversal as in a short-term correction. I think it's something that's necessary and needed at the moment. You can see the market's getting pretty overbought and pretty stretched out. And I think at this point we need to pull back and at least consolidate and see some profit taken in order to be able to get a little bit more new buyers and new bulls into the fray and into the being able to push the market upwards again instead of keep squeezing higher. The longer that this drifts like this, the more likely that when we do correct, it'll be pretty sharp. So at this point, we want the market to start drifting back, and just finding some sellers and being able to find new buyers that come in at lower prices. This is a predicament that you always find yourself in when you have a market that's just slowly drifting upwards like this. You can see we've got sort of a rising wedge. Let's fix that trend line. When you have the action like this, what ends up happening is the sellers have no impact on the market right now, right? They just can't push the market down, and it forces buyers to continue to chase the action higher and higher. What happens is the buyers that chase the action higher are typically weaker, as in the weaker hands, the ones that are more likely to cave into any kind of selling pressure. And the more and more of those that filter in, and the less and less that value buyers come in, the more likely that this eventually drops strongly, shaking out all of those that are chasing the action and trying to get in at highs, and then eventually you'll have the price come back down to a level of support or a value area, at which point the smarter money or the more patient buyers will step in and add new fuel or new energy to the market, and at that point it starts to rise again. So what we're looking for right now is a price correction, and I think we're seeing signs of that across the board, and I think it's likely that we do finally pull back in the next couple of days and into the rest of this week, and at the very least come back and test our 20-pair moving average. And we'll go over the four major market charts, and we'll see exactly why I'm thinking that. But you can see on the S&P 500, we started to accelerate, and this is a pattern that we discussed a bit last week. And what ends up happening when you have a steady drift upwards like this, once you start to accelerate above it, that's usually the sign that it's starting to get tired and it's going to need to come back down. And it's funny, you would think if it's accelerating that it's not getting tired, that it's getting new energy. But what ends up happening is a lot of times this is sort of the last gasp effort of it to keep going upwards, and then eventually you'll have the sellers finally come in and you'll find enough supply to push it down. And I think that's what's happening right now. As you can see, we started to push upwards. You can see volume was increasing on it, but we weren't really going anywhere. And now we have a string of three dojis as we struggle to reach new highs. Yesterday we had a shooting star, and today we printed new all-time highs on the S&P 500, but we're kind of drifting here and coming back towards our price action from the last couple of days. And the more likely scenario is that we end up maybe not caving in today, but maybe caving in tomorrow or Friday, and coming back down and starting to test a little bit lower. And we'll go over the key levels that we need to watch on the S&P 500 in a second, but I wanted to point out again exactly why this occurs, right? So we're going to zoom in pretty closely, and you're going to see. Now, one thing I do want to point out is that this type of behavior doesn't always lead itself to a correction, so don't get excited and short it yet. I think what we want to do right now is be patient and wait for a further pullback and then just buy the dip. Because as you can see, the last time we drifted upwards, we did have some dojis in here, and we even had a little shooting star as well. So these kind of candles give us a hint that there's more selling pressure and more distribution coming in, but they don't necessarily tell you that it's 100% certain that we're going to pull back. Now, I think the fact that we are seeing them after an increase in volume and a move upwards above our channel gives us a better chance of a pullback than what we saw over here. You remember last week I thought there was still a chance that we continued drifting higher because I didn't see enough signals telling us that the market was ready to pull back, but I'm starting to see more signs of selling pressure and more signs of supply coming in, and I think it's hinting at a pullback. And I think the key is how far do we pull back once we do have a profit taking. And I think ideally what we want to see is just a pullback to the 20-pair moving average. For those of you that are regulars, you'll know that I've been looking at a market that's been rallying steadily, and it's something we've anticipated. From the end of last year, we were looking at a market that could possibly rally for several months, not just for the month and a half or 2 months that we've seen so far. I think that we have a market that is strong enough that we could rally all the way through spring. And if that's the case, we want to make sure that we are buying pullbacks and we are taking advantage of that trend if it continues in that manner. And I think the idea for that now is once we do have a pullback, we want to see how far we pull back and to what levels we pull back. We don't want to see a 50% retracement of this move that started back in October, November. What we want to see is a small retracement back to the moving average, or we want to see a more defined channel forming, letting us know that price action is steadily climbing, right? We don't really have that at the bottom, right? We have the top. The top has been, for the most part, a pretty steady channel. But if you look at the bottom side, we've just been rising. It's been a rising wedge for a while now, really. If you really want to go ahead and take a look at it, it's basically since we had that pullback in December, we've basically just been going up in a rising wedge. And like I said, this typically lends itself to a pretty sharp correction. Once you finally have the end of that wedge, you go through the apex, and a lot of times it happens the way we're seeing right now, which is you get that bump up trying to go through it, and then eventually it rolls over and you get the sharper drop to the downside. So what we want to see now is we don't want to see it drop all the way down to, I think if we get to 320 it's okay, but we don't want any lower than that. We don't want it to go through the 50-pair moving average. We don't want to see a retracement through half of this. If we do see that, it's not the end of the world. I think that we're still in a strong market. But if we want a market like what we've seen in the past, right? So I'm going to go back again and zoom out to the market that I think we're most into, or most similar, which is what we saw in 2017 right after the election, which was a market that just steadily climbed for over a year, right? And I think that we are in a market that's very similar to this, and a market that can continue climbing upwards steadily for the next several months, if not for the rest of the year. Now, I think that we will probably get some substantial pullbacks. It won't be identical to what we saw in 2017 or what we saw in 2013, 2014, but I think that there's a chance that we have a market that continues just climbing steadily throughout, at least, at the very least, through the next couple of months. And if that's the case, then we don't want to see. We just want to see it continue to form a channel and continue climbing higher. Now, I will say the channel we're forming right now is pretty steep, and that's usually not as sustainable as one that's a little bit more steady. You'll notice that the last time we broke out, it was kind of a 45-degree angle, and it kind of just kept going upwards. Once you start getting an angle that's as steep as what we're seeing here, it's a little bit more along the lines of what we saw at the end of 2018 and the beginning of last year, where we had a very quick climb upwards, and then eventually you have that drop, right? It's actually very similar to what we saw to start last year, where we had the big move, and it continued for several months. If you notice, it went from basically January all the way up to April before we had the big drop. And it wasn't even that massive of a drop, but when we had our first real substantial correction. We had a minor correction here in March, but the big substantial correction was in April to June. And we're kind of doing the same thing. We're just climbing upwards, and there's room for another month or two of climbing before we have a strong correction. Now, that might not be the case. We might get the correction right now, but I just want you to keep in mind that there is the possibility that we continue to climb upwards, and if we do, we're going to form a channel. And if we do form a channel, well, then we'll have a better idea of where we want to buy dips at that time. So that's one of the things we want to look at right now, is the possibility of a channel like that developing. Now, if it doesn't, and we do pull back, Well, what are the key levels we want to watch, right? So the first key level is the 20-pair moving average. The next key level is down here at 320. And I think this 320 level is going to be the critical level as far as making sure that we have a move that's going to continue climbing over the next couple of months. If we lose 320, then I think that it's more indicative of a market that's going to base out and spend some time trading sideways. And that might be through the rest of earnings season, or it might be into the next FOMC meeting. Not really sure. But that would be the substantial level, of the key level we really want to watch right now is 320. That's going to coincide with the 50-pair moving average as it comes up to meet price. And like I said, as long as we stay above that, I think that we can assume that the market is still climbing pretty steadily, even if we do get a sharp pullback in the next few days or the next week. Now, if we lose 320 and we start to come back down towards this area around 313 to 310, then, like I said, I think that's indicative of a market that's going to stair-step a little bit more. And we might end up seeing is something similar to what we saw from August to October last year, where the market needs to spend some time trading sideways and kind of consolidate and finding enough new buyers that view this area around 310 to 315 as value. And if we find enough bulls that find that as a good deal, then we'll start to make our way back upwards, and we'll start to accelerate and start to shift upwards and rally again. But for now, I'm not anticipating that. What I'm anticipating is a pullback that's going to either hit the 20 and start to move up again, or is going to hit this level around 320 and then start to make its way back upwards. Now, keep in mind, the more likely, and I think what's most likely to happen, is we're going to eventually pull back off of what we're seeing right now, right? And then we're probably going to hit our 20-pair moving average. And then from there, try to bounce again, right? And I think that's what we really want to see is, does the bounce push us upwards, or does the bounce fall short of the highs that we're printing? If it falls short of the highs we're printing, then more likely than not, we're going to make our way back down and start testing the 50-pair moving average. So that, I think, is the key. Is I think we're more likely than not going to come back and test the 20 and bounce. And so what I'm really watching as far as a bull looking for a new market rally and for the market to continue rallying is seeing how we bounce off of that 20-pair moving average. Are we going to fall short of the new highs, or are we going to push through them? And if we eclipse them, then we can assume that we're still in a very strong channel moving upwards. If we falter and head lower, then again, I think what I'm looking for is strong support here around 320, strong support around the 50 if it comes up to meet price a little bit higher. And then from there, we'll see what the next step is and where the market wants to move. We're in the middle of earnings season, and in general, I prefer trading earnings trades during this time rather than trying to trade the market and swing trading. So I'm okay with waiting to see how this plays out. We had a very good trade on Netflix yesterday. For those that maybe are Patreon subscribers, you'll know that we were looking at Netflix, and we thought that the volatility on it was a little overpriced, and we expected it to remain pretty much stationary. If you take a look, this white box here is the expected move on Netflix yesterday. It was expected to move about 8%, and as you can see right now, it's down about 2%. So we didn't play it with a direction. We played it just looking for it to move less than 8%, and so far that trade has worked out very, very well for us. And I'm expecting max profit in the next couple of days as more of that options volume or options volatility disappears, and we lose the rest of the premium that's still lingering in the options. So overall, that worked out very well for us, and that's how I tend to operate during earnings seasons. Is I like to look at names and try to figure out whether I think that the options, the move that's expected by options, is either overpriced or underpriced, and then go ahead and trade it according to that. And I think in this particular case, it worked out very well for us. And I'll be looking at more of these types of trades over the coming weeks. So if anyone is interested in this sort of thing, go ahead and visit my Patreon page at patreon.com/StockDarts, and you'll see what kinds of trades we're looking for. So I'll be a little bit slimmer. There'll be a little bit slimmer pickings as far as swing trades, but I'll be looking at a little bit more options types of trades as far as earnings are concerned. And one thing I do want to warn anyone that is trading, if you're a swing trader, because we're in earnings season, make sure that you keep track of whatever stock you're looking to swing trade when they have their earnings report, because the last thing you want is to be caught by surprise and have an earnings report that moves your stock 10, 15, 20%, and it could be in the wrong direction. And if it's something you weren't anticipating, you could end up taking much bigger losses, or even just exposing yourself to much more risk than you really expected to. on a normal swing trade. So make sure that whenever you're trading, you keep an eye on it. Now, if you use TradingView like I do, it has a nice little red box. So for instance, we can look at, say, Apple, right? And it tells you in how many days they're expected their earnings, to report earnings. So you can see Apple's reporting in about 6 days. The rest of the FANG stocks are actually reporting the next 5 to 7 or 8 days. So a lot of big names are going to be reporting soon, and I think that's going to have an impact on the market. And that might be what the catalyst we need to pull back a little bit, or it might even be the catalyst to continue this sort of blow off top. But keep an eye on that, because the last thing you want is to swing trade a name and not realize that it reports earnings, and then you wake up to a 10-15% gap on a name that you didn't expect. And again, it could be in your favor, but more likely than not, what happens in these cases is it goes against you and you weren't really ready for it, and you end up taking bigger losses than you expected. So just make sure you understand your risk involved when you're taking a trade during earnings season. So that's the S&P 500. Like I said, I don't expect anything in the near future to push the market past 320 to the downside. I think that we're still drifting upwards, and we still haven't found any sellers. Despite the fact that we're starting to see some signs of selling, they have not made a big enough impact here to get too worried. I think once we do get enough of an impact, and the sellers are able to push the price action down, they're likely to push it down to the 20-period moving average, and possibly down here to about 325, 326. And from there, we'll see exactly what kind of impact the bulls have in turning the price action back around, and see whether they could push it back to new highs, and we could develop a more steady channel, or if we need to spend more time trading sideways and building up some pressure to go ahead and stair-step our way upwards. Like I said, it's starting to get pretty stretched out, and I expect us to pull back. So make sure if you are trading to the long side that you're finding names that give you good risk reward, and you're not chasing the price action upwards, because the market's starting to look like it needs to kind of pull back and step back for a bit. Now, if we take a look at the NASDAQ, you'll see the same thing, if anything even more exacerbated. We have a rising wedge, which is getting pretty tight here, and while we don't have quite the same sort of rollover candles that we're seeing in the S&P 500, it's the same scenario, right? We're starting to get stretched out, and we're starting to get a little overbought, and very often with these rising wedges, you get like a 2 or 3 day correction where you get a big red candle, then another red candle, and then from there you maybe find some stability. And so I think we're getting pretty close to that. So same thing as I mentioned on the S&P 500. I think at this point it warrants caution to go ahead and trade to the long side. Despite the fact that I think we're still in a very bullish environment, the fact that the markets are getting stretched out here is telling us that our timing is a little off if we go ahead and chase price action here. So if you do want to trade to the long side, make sure that you are finding names that are either ahead or lagging behind what we're seeing in the overall markets, right? So they either have already broken down and have found some support and are starting to bounce again, or they are sort of lagging behind and still have room to the upside and are coming off of consolidation patterns where they give you good risk reward. And then finally, again, if you want to trade to the long side, but you don't like trading options, and you don't like trading options the way that I do, you don't have to. You can always wait for names to report earnings and then put them on a watch list and see if they give you moves after their earnings, right? So again, Netflix, I'm not saying Netflix is providing an opportunity yet, but if you're bullish Netflix and you wanted to go ahead and trade them to the long side, well, they've already reported earnings, so you've got plenty of time. You've got 3 months for the next earnings report. So now what you want to do is you want to watch them develop a pattern that you have confidence in and that you would want to trade to the long side. So maybe what you'd want to do is watch something like this. And wait for this to resolve, and then play them if they break to the upside or if they break to the downside. And that way you've avoided earnings, and you have a name that's not exactly doing what the market is doing, because typically the earnings is going to override whatever correlation they have with the market in the short term. So, this is the kind of stuff maybe you want to start putting on a watch list. I don't think Netflix is ready to trade right now. I think Netflix is going to stay stuck chopping around for the next few days as it tries to figure out what it wants to do, and it tries to really take into account what the earnings report had. But you want to start looking at names like this and start putting them into watch lists, and then that way you have names that are moving a little bit different, a little bit of a cross current to what the overall market is doing. And at the same time, if you're not comfortable with options, you don't have to actually try to trade the earnings report with options. And I think that's a valid way of trading. And it's a valid way of navigating through earnings season. Is just wait till the earnings reports, and then just try to find names that you could trade the day after or even the week or two after. There are a lot of times that you'll find a strong name that has a gap down, and then they give you a good bounce play if they come down to nice levels of support, and they're a name that is well trusted and that often finds bulls that step in anytime there's a drop on it. So there are a lot of ways of going through and avoiding the risk that you find in earnings season, and still be able to trade, swing trade in a normal manner without having to do stuff, these exotic plays like calendar spreads or credit condors or just iron condors or stuff like that I like to take. So keep that in mind, and make sure that you understand what you're doing during this, and you have these sorts of market environments, and that you have the right play involved. All right, so looking at the key levels of the NASDAQ, it's going to be the same as the S&P 500. I think if we do pull back, we're going to likely come back to the 20 per moving average, at which point we should find some temporary support, and I think the manner with which we bounce from that 20 should give us a better idea of what we can expect out of the market. As far as the Qs are concerned, the big level of support is down here at 211. That's a lot of room to the downside, and the 50-period moving average will come up and meet price if we do get to that. I think as long as we stay above that, then we're still in a pretty steady market that is probably going to continue climbing pretty easily. If we fall below that, then I think, like I said, we're more likely than not going to be involved in a market that needs to trade sideways and is probably going to stair step, at which point we might find ourselves in a similar situation to what we saw last summer to fall, where we just traded sideways for 2 or 3 months before we built up enough steam to resolve it to the upside. However, even if we do pull back to 211, even if we pull back below that, I think we're still in a strong bull market. I think we should still be looking at buying dips, and we should still be looking at trading to the upside, not trying to short this market. There's a lot that needs to happen before I worry about this market as far as being in a bear market or rolling over or topping out. That we're in a very strong bull market, and there's a lot of damage that can be done before we need to worry about the overall health in the long term of this market. Now, that doesn't mean you should ignore your stops, because there's a lot of room to the downside where the market is still in a bull market, but you may not be able to absorb those kinds of losses. So make sure that you understand what risk you have involved in each play. You have your stops in place, and you still take them. You don't want to get complacent just because the market's drifting upwards, and you start breaking your rules and just holding names because you think it's going to come back up and the market's going to bump it up for you. Those are the kind of habits that traders get into, and then eventually they blow out their accounts because they'll get caught by surprise on one name in particular that'll just ruin them. So make sure you understand that, and you maintain your discipline when you're trading. A strong market like this, you're supposed to take your losses and then just wait for the next trade, and more trades than not will pan out if the market continues behaving in the way it has over the last few months. All right, so we look at the Dow Jones. You'll see something similar, not quite the same. You'll see that we've already had 3 days of selling, despite the fact that we hit new all-time highs a couple of days ago. And we don't have quite the rising wedge of the others, but it's still very similar, right? And you can see we're starting to pull back a bit. Now, we have held up in a bull flag, right? And that is a possibility, is that despite the fact that it looks like we're ready to correct a little bit more strongly, the 3 major indices, the S&P 500, the NASDAQ, and the Dow Jones, they're still holding up pretty steadily. And we have seen a decent correction on IWM. So it could be that this bull flag is what we get, and then we start to climb upwards again. Which is why, again, I'm saying don't try to short this market. Just wait to see what kind of pullback we get. Maybe the correction we get is just going to be another 2 or 3 days of sideways action, and then we resolve to the upside. So what we want to do is be patient, wait for the right time, and then go ahead and take advantage of it and then buy. It could be that we move back to the 20, or it could be that we just trade another day or two sideways and then we break out. And if we do, at that point we should have the chart set up at least a little bit better to go ahead and trade some momentum plays to the upside. Might not be how the S&P 500 and the NASDAQ shake out, but if the Dow Jones trades a little bull flag and starts to move upwards, it could be that the other two drift upwards with it. Ideally, I think I still want to see a move to the 20. I prefer to get a stronger reset and to get more, to shake out more of the hands that have been chasing this price action upwards. Um, but keep in mind that there is a chance that we do just trade a bull flag here and then start to climb upwards. If we do, I think it just extends this wedge a little bit further, and I think it still gives us that we're still going to be watching for the same pattern. It's just going to delay it a little bit more as it, we move upwards. It'll delay this process, but I think we're still going to eventually see this process where we get a little bit more of a substantial correction, and then we'll see whether we come down to the 20 or to the 50 per moving average. The Dow Jones is the same as the S&P 500 and the NASDAQ in that we have a pretty critical level here around 284. And as long as we stay above that, you can see it coincides with the 50 just like the other two. As long as we stay above that level, I think that we're still in a market that's steadily climbing, even if we do get a sharp pullback. If we fall below that level, then I think, like I said, I think it's more indicative of a market that's going to spend some time trading sideways and stair-stepping a little bit more. I don't think that we're going to get to that level in the next week or two. I think, if anything, it might be an FOMC meeting that puts us to that. Or if we have a bunch of bad earnings reports in the next 2 weeks. And then maybe that would be what pushes us down to that level. Or maybe something with the impeachment trial, or something with coronavirus. It's going to have to be a pretty big scare from the news in order to get us down to that level in a week. I think that this is the kind of level that we're going to get to in maybe by the middle of February if we get sustained selling. But for now, like I said, I think what I expect is a move to the 20, and then we try to bounce, and then from there, if we fail that, then maybe we come down to the 50. And like I said, that might be 2-3 weeks from now if that happens. Now, the last one we want to look at is IWM. And as you can see, IWM is a bit different, right? IWM actually had the more steady consolidation before we started to rally up here in January. But it has found some pretty strong selling over the last 2 or 3 days. And I think that if there's one index that's definitely going to pull back further, it's probably IWM. However, you can see IWM has found some key support here around 167 and is kind of holding steady. And I think we'll see what happens here in the next couple of days. If IWM can stay above 167 and do something like this, well, then there's a chance that the other indices just kind of hold steady and print a bull flag and then start to climb upwards. So we'll keep an eye on that. I think IWM, like the others, probably wants to come back and test this 20-pair moving average. You can see that there's still a lot of selling pressure in the small caps. And you can see that when the market is ready to pull back, we're still seeing it first in the small caps. So traders are still getting rid of the small caps, or getting rid of the more volatile assets more quickly than the others, right? So this is the same pattern we've seen for quite a few years now, where whenever the market is ready to pull back, we see it first on IWM, and we see the bullishness persist a bit longer on some of the safer names that you'll find on the NASDAQ or particularly the S&P 500 and the Dow Jones. Although the NASDAQ lately has been pretty strong. I think a lot of tech names have been holding up very well over the last couple of years. And really what we want to see on the IWM is the same thing as the other two. We want to see a pullback to the 20, but I want to see IWM get more bullish before the other three. I'd like to see the other three pull back to their 20 while IWM starts to make its way back up towards highs. That's probably not going to happen, but there's still room to catch up here. IWM still has not hit new all-time highs, and I think IWM needs to participate. If we're going to get a move like we saw in 2017 or like we saw in 2013, 2014, I think we need a little bit more participation out of IWM. Now, it has done well. It has done exactly what I expected it to do last year, which was to break 160. I thought we were 158. Once we broke 158, that's really what led to the market taking off. And I think the next key for the market to really take off is for IWM to hit new highs. There's still room for that, and there's still room to play catch up here. And I think that's the next key development that we're going to need. And more likely than not, what's going to happen is IWM is going to reach those highs and then probably find rejection at that level. And I think that's when we'll get that's when we should probably anticipate a stronger correction in the rest of the indices. And that would be the scenario that I think is the most likely to happen and the one that I'm anticipating. And of course, I'll keep in mind if things change, then I'll have to change my view and That's why we meet every Wednesday, is to go ahead and update our view of how these indices are moving along with each other. But I think ideally what we want to see is IWM pick up some steam here and start making its way. Now again, I don't think it's going to reach. I think the scenario I was just talking about IWM hitting new all-time highs or reaching those all-time highs, I think that's still probably a couple of months away. I don't think IWM is ready to hit those levels, or maybe a month away. I don't want to be too conservative about it, but I think that it still needs more time to hit that level. I don't think it's going to hit that in January. We've only got about a week and a half left to go. But I think at some point in February, we're probably going to make a push for these all-time highs, and I think that's going to be when we have the first really strong test as to whether this market is going to correct more sharply or not. Which is why I think at the moment, more likely than not, we're going to get a more shallow pullback to the 20-period moving average and then try to bounce again, because I think we're waiting to see what happens with IWM and where it can go next. Now, along with the other three indices, IWM does have one thing that's the same, which is our key level is down here around 163, which is also very close to the 50-period moving average. So all four indices have the same horizontal level right next to the 50-period moving average, which I think is the key as far as judging whether we're going to continue just steadily climbing or not. As long as we hold above this, I think we're in good shape. If we fall below 163, we fall below the 50, then I think that's a pretty big warning sign as to where the market wants to go. And like I said, I think it's more indicative of a market that needs to trade sideways and base out for a bit longer. But I think that that's not something we need to worry about from here to next week. I think that's something that we need to worry about in February. I think from here to next week, we want to see what happens to the 20-period moving average, and we want to see what happens if we can start to get back above 170. But more likely than not, we need to test down here around 165, 166, maybe even 164 before we see where IWM wants to move next. So if you want to be a step ahead of the market, keep an eye on IWM, because I think that this one is at least giving us the more clear picture of the selling pressure that we're seeing. It seems like the other three indices are holding up very well, despite the fact that we are seeing selling pressure across the board. And it really, they're absorbing the distribution and the supply a little bit more easily than IWM is, but it's there. And it's really a matter of, are we going to find enough bulls to continue to eat up that supply and then be able to push through it or not? And I suspect that there isn't. I suspect that we do need to pull back here. And that's what I'm waiting for. I'm actually waiting for a pullback so that we can find better areas to go ahead and buy. And until then, I'm probably going to be, like I said, I'm going to be focused a little bit more on earnings trades or swing trade names that have already posted earnings and give me a little bit of a clearer area to trade without worrying about the stretched out nature of the market at the moment. So that's our environment. That's where we stand right now. Like I said, we are in a market that probably needs to pull back a little bit more, but I think it's a good pullback that's necessary. I don't think that it's indicative of a market that's ready to top out. I think it's just a market that needs to reset and needs to find new buyers to continue driving it upwards. But like I said last year, and like I've said to start this year, the market right now is showing a lot of strength, and I think that we are in a market that we can continue to ride higher. We just want to, at this point it's starting to get overbought, so we want to wait for a little bit of a reset. We're going to go over the U.S. dollar and gold, oil, and silver real quick, and then we'll move on to the chart requests. Those of you that are in here, if you have a chart request, feel free to type it in there, and I'll go ahead and take a look at it and see what I can think of your chart. Let me know if it's a stock that you already bought, or if it's one that you are looking to enter. That gives me a little bit better idea of what I'm trying to find out on the chart for you. Here's the U.S. dollar. The U.S. dollar has actually found some support and has tried to bounce and has done a decent job. I thought it was going to pull back a little bit more quickly than it has so far. I think that we found ourselves a bottom. I still think that it's probably more likely than not going to pull back in the near future, but it has shown some signs of bullishness recently. And there is room to the upside here before it finds itself into more substantial resistance. We've got the 200-period moving average on the UUP index, and we've got this area around 2650. Now again, this index is really an aggregate of all the major U.S. dollar crosses. So I like to look at those crosses rather than the UUP index for actual technical levels that I want to worry about. And I think the chart that has the most impact on it is the Euro U.S. dollar cross. And this one, of course, is in inverse, right? So in this one, the Euro up is good for the Euro and down is good for the U.S. dollar. And as you can see, the U.S. dollar has been able to push back on the Euro and stop it from really gaining above a pretty critical level here around 112. I didn't think that euro was ready to get above that. What happens often when you have a stock that's been steadily declining, as long as the euro has, and again, you look at the weekly chart, you'll see it's been a very steady decline for quite a while now. Once you establish a bottom, you don't normally just kind of start climbing back upwards unfettered and reaching back towards those highs. What ends up happening is you end up trading sideways, and what you do is you go from bearish to neutral, and then eventually to either bullish or to bearish again. And so I think that the euro right now is in neutral, and I think it's going to be trading sideways. And I think it got a little ahead of itself as it tried to break past 112. And as you can see, we have kind of a textbook bearish play here, where you have a slice through the channel, you break underneath it, then you come up and try to re-enter the channel, fail, and roll right back over, right? So all this is indicating bullishness out of the US dollar and bearishness out of the euro. And now the key is the euro going to come back and revisit the new lows around, or its recent lows around 110 and possibly all the way down around 109? Or is it going to continue chopping back and forth and try to make its way back up and maintain the short-term bullishness that it's had, right? So long-term was bearish, intermediate term is neutral, but short-term is kind of bullish, right? Until, well, the very, very short-term is bearish. And so at this point, the euro is either going to try to bounce right back and make its way back to 112, or it's going to continue dropping down. And I think what we want to see here, it's going to probably try to bounce in the next couple of days, and we'll see what happens as it hits 112, or 111.3, right around the 200-period moving average. More likely than not, it's going to find selling pressure and start to dip down again. And if it eclipses these levels, then it'll come right back down to 109, 110. So I think it's in the middle of a range right now, right? We've got resistance around 118 to around 111 to 112. We've got support way down here around 110. So there's plenty of room on either direction. So I think what I'd want to do in this particular case is wait for a failed bounce, and then you could look at a short play, or you wait for it to come all the way down to 110 and then try to play a bounce play there, right? So plenty of room in either direction. I don't think that there's enough price action here to really tell us what it wants to do next. I suspect that it's going to bounce, and it's going to be a short bounce and then probably roll right back over. But there's always a chance that it finds enough buyers to come back up and challenge this 111.8 to 112 area. Now, we'll go to the Canadian last. In contrast to that, if you look at the U.S. versus the yen, the U.S. dollar, actually the U.S. dollar has been strong against the yen as well. And as a matter of fact, it's been strong versus the Canadian, which we'll get to in a minute too. So I think across the board, we're seeing the U.S. dollar pick up some strength, which is nice. And now the question is, can it sustain this? Now, this is a pretty critical level to break on the yen. The yen has been weak versus the dollar for a while now, and it continues to act so. And despite the fact that we had a pullback yesterday, I think overall it's consolidating above a key level. And as long as it stays above that, it'll likely continue to play upwards. And I think that this one has been one of the stronger U.S. dollar crosses. And if you're a Forex trader, this is one of the ones that has provided us with easier long trades than maybe against the euro. But I think overall, again, this is showing that the U.S. dollar is gaining strength as well. And then finally, we have the U.S. versus the Canadian. And this one has actually had a very strong move over the last couple of days. And again, this one moves inversely to oil. And as we can see, we're going to jump real quick to our oil. You can see oil, again, very similar to what I just mentioned in the euro. A lot of times what happens when you end up slicing through a channel like this, you try to get back in that channel and then you ultimately fail. Then you get a pretty strong move to the downside. And that's what we're seeing on oil. And oil, again, has really struggled. It's something we anticipated last week and the week before when we saw this action up here. And I think at this point, oil again is probably looking to make its way down to 55, 54, and try to find some support here. It's got long-term support in this area around 55, 54, and that's where it looks like it wants to head. And again, very often the U.S. Canadian trades inverse to that, and that means that we're likely to see more strength out of the U.S. Canadian. It looks like it found a range here between about 130 and about 133. And it found the bottom of that range, and so it's probably going to try to make its way back up towards the top of that range. It'll probably get stuck here around the middle, around 130.17, but eventually probably try to make its way back up to 133. So I think overall, if we look at the U.S. dollar again as an aggregate, you can see that despite the fact that it has had a pretty decent bounce and is coming up into resistance as an aggregate. As we look at the individual crosses, they all look like they do have potential for more room to the upside once they stabilize and hit that resistance that they found recently. So what does that mean? That means gold and silver might end up running into more overhead resistance than anticipated, or than what we thought was maybe likely prior to this. Oil and gold in particular had a very strong move to the upside, and then as I mentioned last week, it had a pretty steady pullback, and it did have a nice buy signal, and it really hasn't done anything since then. And I think that's a function of a strong U.S. dollar, and it's held gold and silver in check despite the fact that they look like they wanted to bounce. And this is why it's important to look at all these together, is because they have an impact on each other, and there's often a pretty decent correlation between them, or inverse correlation. And I think we need to see the U.S. dollar sort of pull back a bit, get tired, before we see gold and silver move. Now that could happen. In the short term, like I said, I think the euro probably wants to bounce a bit. And I think that the U.S. dollar might need to pull back a bit against the yen. And same thing with the Canadian, where it might want to flag a bit. And if it does that, then that's going to give gold and silver a little bit of an opportunity to try to bounce here. But if the U.S. dollar continues and resumes the move that it's had against those three currencies, there's a decent chance that gold is going to have to lose its 20-pair moving average and probably head a little bit lower. So keep that in mind. I know, Ray, you're in here, and I know you've been trading gold to the long side. Like I said last week, I hope you took some profits when you get this big bounce, because a lot of times what happens is you get these big moves and then it chops around for a while before you get the next move again. And if that's going to be the case, then you want to make sure that you aren't letting that triple leverage move or your options decay against you while this thing chops around. I still think there's a chance for gold or silver to continue moving upwards, but you need the U.S. dollar to cooperate, and I'm starting to see signs of the U.S. dollar gaining strength against quite a few different currency crosses. And so if that's the case, you don't want to be surprised if it does rally strongly and it punishes gold and silver for it. Okay? So that covers gold, silver, and oil. If anyone has any chart requests, now's the time. We've got a good 10-15 minutes for it. And I'd love to see what you guys are looking at as far as trades that are maybe working for you or not working for you. For those that follow me on Patreon, like I said, we've had a very, very nice last few weeks. Not to kind of harp on the same thing, but we had BYND and SHAK, which have done very, very well for us. And then we have TRP from a couple of weeks ago that also has done very well for us, along with our NFLX trade from yesterday. So we've been on a really good winning streak. We've only had a couple of trades that really haven't panned out for us. One of them being AK Steel, which did not work out for us, but we had a very quick stop out on it. And then we had this one, which has not really done anything after our trigger, but it hasn't really stopped us out either, but it's just kind of drifting sideways. But for that, other than those two, the rest of our stocks have all done very, very well and have given us very explosive profits. And so it's been a pretty good start to the year. And I think that often, when you see a market like this, you're going to have names that just give you strong moves. You just want to make sure that you're taking advantage of it and you're trying to make the right plays. And if you're having trouble finding stuff like this, like I said, you can always follow me on Patreon. Some of the trades are under a subscription, but it's only $8 a month. And even then, I will often put them free after a week or two, and you may not be able to trade them, but at least you can see the thought process behind it. And every now and then, I do put free content on there as well. All right, Ray, you have a couple. You have ISR, which is doing very, very well. It's okay. Okay, so it's a cheaper stock, under $1. All right, Ray. So this looks very nice, unless you bought this yesterday or today. I'm hoping that this is something you've already been in, because it's doing very well, but it's also had a very explosive move already. Whatever this is, so this is a biotech. All right, ISO-Ray. So I'm wondering, is this one of these stocks that does well whenever we have a flu scare or a virus problem? Very strong move. You can see it's struggling against the dollar, And I mean, this is good. What these types of these kind of low float penny stocks, uh, you want to see volume come in like this, right? This is a change in character. This is a stock that has gone from a name that wasn't really doing anything to all of a sudden news came in or something came in that changed the outlook on this stock, and it's had a very strong move since then. Um, so you said ISR in at ISR. I believe you mistyped that. Um, and it's these kind of names can continue. They can have very explosive moves, and they can continue climbing for quite a while, depending on what the news is or what it is that changed the outlook on the stock, right? So um, I hesitate. Usually on these, I'll say, well, you should take profits because it's up very strongly. You're in at 77 cents. Very nice. Okay, so you got in at a decent price. Not the greatest, but at least you were able to get in off of this pullback and then the breakout from it. Ideally, the best place would have been to get in the 60s, but that's hindsight trading. I'm not going to really harp too much on that. But okay, so you're in at a good price. It's coming up to $1. I don't know how much you have, but when I see strong moves like this, I usually want to take profits, at least on part of it. However, like I said, with these types of names, they have such explosive potential that you don't want to give up too much too quickly. So in this particular case, rather than maybe scale out a half a trade like I normally do, maybe you'd want to scale out at 25%, just a quarter of your trade, or maybe 30, maybe a third of your trade, and then hold the rest for a stronger move to the upside. And what happens in this particular case, if you close out, say, a quarter of your trade, if it does pull back into the 80-cent area and then starts to find support, then you could re-enter that quarter position. You have a small position. Well, yeah, I don't know how small your position is, so maybe that's not an option. If that's, this is when you have something like this, you want to make sure that you hold on to it long enough for it to be very, very profitable. So you don't. I think at this point it's very strong. I wouldn't close it out. Like I said, I would probably close out a quarter position and then re-enter if it comes back down. But if that's not an option, if it's so small that the transaction costs will make it tough for you to even do that, then I think just hold on and hope that it moves in your favor, and just put a stop at your entry, or maybe even just down here in the 70-cent area or 65-cent area, and see what it does, right? Because it can pull back all the way down, even all the way down to 60, and still be strong, but you don't want to be negative on this. So maybe just put a stop at your entry or just below it, and hope that this can push through $1. I think if it pushes through $1, then you're safe, and that could be the new area that you could look at. But it's pretty strong. This is a little bit different from a normal stock where you don't want to just take your profits here, because when you have a name that has this kind of volume pump into it, especially a biotech, it could continue to run much quicker. Now, the opposite is true, of course. It can always just, whatever the news is could have been false, and it just gives it all back and fades all the way back to the beginning. So you don't want to just give it away for nothing. So that's why I said I personally had to at least take partial profits. But if you're in a position where you can't take partial, then hold it a bit longer and wait for a reversal signal before you close it out. All right, TMRC, Texas Minerals Sources. Well, this one's not looking quite as well. Is this a? This is an OTC. Was the other one? The other one's not an OTC, is it? No, ISO raise on. Okay. So TMRC is an over-the-counter stock. All right. This one I'm a little bit more skeptical of at the moment, right? Because it's coming up into some pretty critical resistance. Even if it does break the downtrend, you've got not only a critical level here, but another critical level right above it. Oh. Alright, so, this thing, my mouse is acting up. What did you do on this one, Ray? I think this is a good spot to take profits. I'm hoping you got in at 70 cents and not here at 85. Again, very similar to ISO Ray, a huge volume coming into this, right? You're in at 92. Oof, you're 92 average. All right, that's all right, Ray. So I don't know what this is a tough one because you're back to break even. Uh, it had a huge move. It retraced what 60% of that move to come right back up to 93. It it's gonna pull back here. I don't. If you're okay, so here's the thing: if you don't want to abandon this trade at break even, you're probably gonna have to hold it underwater for a bit longer. I don't think that this is gonna just. I don't think this is ready to just break through. It could. You never know. But I think more likely than not, when you look at the resistance that it's got overhead, more likely than not, it's going to come back and it's going to have to retest lower, whether it's 82 or whether it's all the way back down at 70 cents. Um, you had bought higher than, so you've been scaling in or averaging down, depending on how much credit you want to give yourself. And you probably, Ray, this is one of those scenarios where you're probably doing something wrong. You say you're looking for a longer trade. I'm hoping that it's not that you're just trying to avoid a loss, right? Because I've noticed that you have, obviously you know this, you and I have had quite a few meetings and quite a few mentoring sessions. And I know you very rarely like to accept a losing trade. And so I'm hoping, you say you're looking for a longer trade, that you're looking for a longer term. So it could be that you're scaling in and that was part of your initial plan, or it could be that you're averaging down because you didn't want to lose after buying the stock initially up here around $1 or whatever you bought it at. And so here's the thing. It's come down, it found support, and it bounced pretty strongly, but it's coming up into very stiff resistance here. 95 to $1 is going to be very critical on this. You can see it's in a pretty steady pullback. And on top of that, you can see it's on the wrong side of what are some important trend lines. We'll get rid of this one because this one's not the one that I'm talking about. But as you can see, it's on the wrong side of two pretty important trend lines. Now, we had this discussion before on oil. I mean, on gold, right? Because this was a discussion that you and I had on JNugget. And how it found it. Wait, no, not this one. Which is the one that. Was it just gold that we were talking about? Yeah, it was gold. When gold was on the wrong side of two critical levels, right? And it eventually was able to push past it. And once it did, it had a very strong move, right? And so this is we're in a very similar situation here, where at the moment, it's on the wrong side of two pretty important trend lines. Not to say it can't get past it, but this is the kind of stock that I'd be more excited about once it was able to push through it. And there's a chance that it does, right? I'm not saying that it can't break through there, but more likely than not, it's going to need to spend some more time underneath this area before it's able to put up enough pressure to get to break past it. Okay, so it's up to you. If you're okay, I mean, obviously you've been in this and you've been underwater for a while now. If you're okay with holding a bit longer, more likely than not, it's going to have to come back down and build up more pressure before it breaks through. And then from there, it should be good. Again, normally I'd say just close it because you've gotten back to break even and you've been able to get away from what was probably a trade that got you into trouble. But this is another name that has had a very drastic turnaround and a very big shift in its outlook. It's a name that was trading very low volume, and all of a sudden, it had a lot of volume kick in, showing that something has changed as far as the stock is concerned. And it had a big move from 30 cents to $1.50. Now, this is the problem I have when you chase these stocks sometimes, right? It had a move from 30 cents to $1, and then all of a sudden you buy it, and of course it's already has such an explosive move, it's going to have to pull back. And that's what it's doing now, is it's pulling back. And these kinds of moves take time. It takes time in order for it to build up enough pressure for the next news cycle to come around and start to push it towards newer places, right? And so this is probably a stock that's going to take a while, and it's probably going to need to wait for another news event in order to push it through, and in order to start pushing it back towards the upper, the $1.20, $1.30, $1.40 area. And until then, it's probably going to chop around between about 60 cents and about $1. So, it's up to you. If you have the patience to wait for it, then go ahead and do, because, I mean, there's definitely potential for this to explode again. You're just going to have to wait for it, because it had a very strong move, but I think it's going to find some some stiff resistance up here in this this area. All right, and then I think the last thing you said was that you were in UNG. I don't like this. I don't like UNG at all. I think UNG is the kind of stock I only ever short. It has a lot of contango effects, and it just always decays. And this is I'm not a fan of going long natural gas ever. You can see it. You can see it very clearly on the monthly chart. You can see it's had a drastic move to the downside, and honestly, Ray, this is one of those stocks where I think you just bought it because it's down. There's no technical signal here that says buy this at the moment. Let me see. Let me scale back and make sure you said, if I remember correctly, you did say you bought some UNG. All right. So, yeah, I don't know, Ray. I don't like this one. I'm going to be completely honest. Even if it does bounce, you know, the best you're going to get is a bounce back to 16. And yeah, that's $1.50, almost $2 in a move. But more likely than not, this thing's just going to keep dropping, or it's going to drift upwards a little and then roll over again. It seems like this. It never does well. The UNG never does. And it's the kind of thing that I normally just like to short. I don't like to play this to the long side. All right, Ray. So out of the three, I like ISR. I think TMRC is okay, but it probably needs more time, and I don't like this one. Basically, there's nothing positive I could really say about this. I don't like it at all. All right, folks. That looks like it covers it for today. Thank you, Ray, for your participation. Thank you those that came and watched. Those of you that watched and didn't have a chart request, if you have one, you can always ask me on Twitter. You could ask me on our Discord chat, or you could email me. I'd be more than happy to give you guys any advice you have on a chart if you're looking for a better read on it and you didn't want to ask in a public forum. Other than that, hope you guys have a good rest of this week, and we'll meet again next Wednesday.